Health insurance becomes a founding decision the moment you form the practice, because forming the practice is also the moment you lose whatever employer-sponsored coverage you had. The path you choose has cost implications, deductibility implications, and timing implications, and the wrong path is usually the one chosen on premium alone without running the after-tax math. 3 paths cover almost every solo coach: a spouse or domestic partner plan, the ACA Marketplace, or an ICF or coaching association group plan. The decision is rarely close once you put the numbers next to each other. 3 things shift when you exit a job and start the practice. You lose your day job coverage on the date the employer says, usually the end of the month of separation, sometimes earlier. You may lose spouse coverage if your spouse changes employers in the same window. The ACA Marketplace is always there as the backstop, but availability does not mean the right answer. The right path depends on your specific situation, your subsidy eligibility, and your filing status. The paths have different cost profiles and different deductibility profiles, and the deductibility piece is the variable most coaches miss when they compare. Path 1 is the spouse or domestic partner employer plan, and on absolute premium it is often the cheapest option when you are eligible. The +1 premium your spouse's employer charges is usually deducted from their paycheck post-tax, which matters because of one specific mechanic. That premium is not deductible as self-employed health insurance on your Schedule C. The self-employed health insurance deduction only applies to premiums you pay directly out of your business account. The spouse plan premium can be the lowest absolute number and still produce a higher total after-tax cost than a marketplace plan would, depending on your bracket and your business income. Path 2 is the ACA Marketplace through healthcare.gov or your state exchange. Subsidy eligibility runs through the advanced premium tax credit, which is income dependent and based on modified AGI relative to the federal poverty level. The volatile income piece is where coaches get caught at filing. If you overestimate your subsidy at enrollment by underestimating your year-end income, you repay the difference when you file taxes. The marketplace plan can be the right answer, even when it is not the cheapest sticker price, because the self-employed health insurance deduction applies, and the subsidy can be substantial in the years where your income is genuinely low. The deduction-subsidy interaction on the marketplace is genuinely circular, and the IRS publishes a worksheet specifically to resolve it. The self-employed health insurance deduction reduces your AGI. The reduced AGI changes your subsidy calculation. The new subsidy changes your effective premium. The new premium changes how much deduction you can claim. The math loops. Publication 535 contains the worksheet that resolves the circle in one pass, and it is genuinely CPA territory, not back-of-envelope territory. Your CPA from Module 3.3 runs the worksheet at year-end and tells you the actual numbers. Do not estimate the subsidy without the circularity in mind. Path 3 is the ICF or Coaching Association group plan, and the answer here varies more by state than by anything else. ICF and some coaching associations offer group health plans for members, and the cost competitiveness shifts year to year depending on the carrier the association partners with and the state availability. If you're already paying ICF dues, the plan is worth checking on the ICF benefits page. Sometimes the rate bundles favorably against marketplace alternatives, sometimes it does not. The plan is not available in every state, and the annual refresh applies. Check it once when you set up the policy decision, then check it again at every open enrollment. What the deduction actually does is worth understanding clearly, because most coaches I work with either miss it entirely or overstate what it covers. 100% of premiums you pay yourself are deductible above the line on Schedule 1, line 17. That reduces your federal income tax. It does not reduce your self-employment tax, and that is the most common point of confusion. The deduction cannot exceed your net self-employment income, meaning if your net income is zero, your deduction is zero regardless of what you paid in premiums. The mechanics live in Module 15.7. The CPA confirms the treatment at year end. March is the worst calendar month to exit, and the COBRA bridge is the move that turns that timing problem into an arithmetic problem. A coach leaves corporate at the end of March. Employer coverage runs through the 31st. Then it's on her. Federal open enrollment doesn't reopen until November 1st, 8 months away. And exiting employment is a qualifying event, but the special enrollment window still puts her shopping in April without the price discipline that open enrollment brings. COBRA pricing is full freight, no employer share, but she knows the number going in and there are no coverage gaps. She uses it as a bridge, April through year end. Then a Marketplace plan binds for the new plan year. Both the COBRA premiums after formation and the Marketplace premiums going forward feed the Schedule 1 deduction. CPA confirms at year end. The path decision sheet is the artifact you take to the CPA and the broker, and the conversation moves faster when you walk in with the 3 paths already mapped against your situation. For Path 1, identify any eligible spouse plan and the +1 premium and the payroll deduction treatment. For Path 2, estimate your modified AGI for the coming year and pull the subsidy calculator at healthcare.gov. For Path 3, check the ICF benefits page for current plan availability in your state. The CPA confirms the deductibility treatment of each path in the same call, because the path with the lowest absolute premium is not always the path with the lowest after-tax cost.